Sorry, guys. This happens every month. Yeah, we live stream. Yeah, we do multiple. All righty, guys. Thank you for coming. This is on video, just so you know. We usually have a videographer, but they were not able to make it. We do here, and then also we do a DC one in the midday, and also have some webinars. My name is Cassidy Burns. I am the owner of BPG. We have residential. Can all of our people that are on residential raise their hands? So you know if you have questions about stuff. We have construction company, property management, and asset management. But this is not about us. This is about you guys, and this is about making sure that you are prepared if and when you are doing business. One thing that I always like to say is come here, take the information that Will and Lauren are going to give you, but then you need to be building relationships with the individuals that are in the room so you can actually go out and implement it, right? So we're going to give you free information. Hopefully you're going to learn something, but if you don't build the relationships with the people that are doing business in this room, you're not going to actually be in the real estate business. So before we get started, we like to introduce everybody that is and see what everybody is actively doing. If you are a lender, raise your hand. Obviously, we have two. Alex Norsini is as well. This is a lender panel. We're going to be talking about debt for investment products, 1 to 4 units. If you're a wholesaler, any wholesalers? No. Fix and flippers, right? Okay. Long-term buy and holds. All right. Great. Short-term rentals. Great. What else do we have? Who else is looking to buy their first property? Okay, great, right? So multifamily as well. Perfect, great. All right, so you saw who's in the room. We're going to give you 30 to 40 minutes of good information. But go and introduce yourself to those people that are actually doing in the asset class that you want to buy. So that's that. Let's introduce our panel. We did have 3. He got in a car accident on the way here. Chris Devine. Yeah, so hopefully, unless Alex Norsini wants to hop up here as well. You don't know pressure. You weren't prepared. Either these guys are not prepared as either because I did not give them the questions that I'm going to be asking. So Lauren Hughes and Will Mitchell both are with First Savings, and I'm going to let them introduce themselves. So Lauren.
Hi, I'm Lauren Hughes with First Savings.
I'm Will Mitchell with First Savings.
Yeah. Okay. And they are lenders, which means that when you buy property, you need to get financing in most cases. If you don't have the cash to buy cash, you have to get debt, right? We're not talking about primary residence debt today. We're talking about strictly investment products, which could be 5, 10, 15, 50% down, right? So we're not talking about house hacking. If you have questions about that, please ask them as we get on. So before we start, any questions from the crowd about anything that we're going to touch on today? All right, good. Hopefully if you don't have them now, we're going to have a Q&A afterwards so these guys can answer questions that are going to be applicable to your situation, right? So I'm going to start with Lauren. And one reason that we brought Lauren and Will here is, one, our team uses them a lot, but also our team has actively bought properties with them using financing. So Lauren has been working with Michael Cook, who is actively buying a short-term rental in the Shenandoah Valley. So we're going to concentrate on STRs with her and long-term rentals because Will helped me buy a property in 2021 in DC as a long-term rental. So Lauren, we're going to start with short-term rentals first. All right, so short-term rental, what are typical investors using to buy these as an investment product?
Well, typically it's the DSCR loan. So essentially we're utilizing the potential rental income from the property to offset the mortgage payment. And that's really all that's used to qualify.
Okay.
So we're not taking into account any of the liabilities for, other properties owned. It's literally just the potential rental income against the mortgage payment.
Got it. DSCR, who knows what that stands for? Say it again. Debt service coverage ratio, which means that can the rent that is coming in from the property cover the debt? And in most cases, what are your lenders looking for from a surplus?
Well, usually at least a 1:0 ratio, right? Obviously, a lot of the stuff that Michael and I have been doing are, at least 1.2
Okay.
and above.
All right.
So,
So 1.2, typically in the multifamily space, it's going to be 1.25, which means that if the debt is $1,000 a month, they are going to want $1,200 a month coming in from rental income. Does that make sense?
and it is different from short-term to long-term rental, right?
Okay.
So you can go lower than one with a long-term rental.
Okay. All
But
right. So long-term rentals, you're getting lower than one.
Mhm.
Okay. All right. We'll touch on that a little more. Will, so when someone wants to buy a long-term rental, they have the down payment. They have 25% down. What metrics are you looking at to underwrite them if they want to buy it in their personal name?
Yeah, so really just qualifying for a standard loan at that point in time. So you're looking at what your obligations are on a monthly basis. Do you own any other properties? Do you have a car loan? Do you have student loan debt? And then you're also using your income. The nice part, though, if you're purchasing the property as an investment, and you can put 20% down, it just gets more expensive, rate-wise or upfront cost-wise. But what you can utilize is the projected rental income. The negative side is you can't use the whole projected rental income. You can only use 75% of it. So it does give you the ability. A lot of people will come in and say, hey, I don't know if I can actually qualify solely on my income, but we can use the future income to help offset some of that debt and that monthly payment to qualify. And we're really looking at a max debt to income ratio of about a 50% on those types of products. So it does require a little bit more documentation and a little bit more aggravation, I guess you can say, compared to the DSCR loans, but it does give you the ability. The rate's a little bit better.
it is.
There are a lot of pros and cons. So depending on what you're trying to accomplish, really is going to determine whether or not you want to use the DSCR loan or the standard investment purchase.
Got it. Okay. Let's talk about rates. So you touched on short-term rental, DSCR, which when I say short-term rental, in most cases, it's going to be debt service coverage ratio type of loan product, unless you bring a significant amount down, versus an investment product. What are the rates for the investment and short-term rental right now?
So for the DSCR short-term rental, say 20% down, 760 credit score, you're looking at 7.625 with, about a 1.5 cost.
Got it.
But that's with 1 year prepayment penalty. So that is a factor that's, more investors are utilizing to help bring down the cost of the interest rate.
Can you explain what a prepayment penalty is?
If you try and refinance within that first year, there's a penalty. And it's different for each investor as far as what that actual cost is. But really, when you're walking into a short-term rental, you don't have a history of rental income. So you have to establish that anyways.
Got it. So prepayment, in most cases, a lot of times people buy short-term rentals. They're buying something that is not an active short-term rental. They're going to buy something. They're going to buy a ton of furniture. They're going to do some rehab to make it short-term rental-esque. And then they're going to try to show proof of income that, hey, long-term rental, this would rent for $5,000, but on a short-term rental, it's going to rent for $12,000. Can you refinance this out? They will charge a point, and that's going to be in your loan docs for that short-term rental. So if and when you're getting financing, make sure that you understand that. Maybe it's beneficial to pay the carry, the debt service, for 366 days, and then look to refinance.
Absolutely.
All right. Long-term rental, what are we looking at?
I would say anywhere around 6.5 with 1 point, give or takes. The points are always going to be the biggest difference between a primary purchase and a single family or an investment purchase. So you're really around, I would say 6.5 with 1, maybe 1.5 in points, depending on the credit score. And there you can always go lower on that as well. Again, you don't have a prepayment penalty on that type of loan, but typically when you go to refinance on investment properties, you're not going to follow what the standard the standard refinance is on a regular home. You're going to probably wait a little bit longer to refinance that to make sense on the cost.
Points. Can you explain what points are?
Yeah, so points are additional costs that you bring to settlement to essentially pay for your interest rate. So we get a list of rates, let's say from 6% to 7%. Every rate has a valuation based off of where the market is at that point in time. And that changes daily, just like stocks do. But you can actually pay more in points to have a lower monthly payment. In turn, you have more cash to close. So 1 point is 1% of your loan amount. 2 points, 2% of your loan amount. 1.5, so on and so forth. So depending on what the break even is, how long you think you're going to hold on to that mortgage, not the property, it might make sense to pay for points. It may not make sense to pay for points, especially when rates are decreasing. You don't want to overpay in points because there is a very likely chance that you will refinance in a year to 2 years or 3.
So essentially, you're fronting the cash up front to have a lower debt service payment, right? But if you see that rates are coming down and you're watching trends that, hey, historically after presidential elections, they come down, valuations go up, maybe you shouldn't buy those points. You should pay and be able to stomach that higher payment, right? But the one thing is, don't buy something that if you're going back to the DSCR, if it's a cash flow asset, don't buy something that's negatively cash flowing with the speculation that rates are going to come down and you're going to refinance, right? You have to understand what the metrics are. And I think that we have a lot of investors that come in and out of here, and they're all speculating on valuations. They're all speculating on what the property is going to rent for, right? Whether it's a short-term or a long-term rental. Make sure that you understand what the rents are currently and if that debt can carry, the rent and income can carry the debt plus your PITI. You talk on PITI and what other expenses come into a mortgage when you're buying that. Yeah.
So, principal, interest, taxes, insurance, any HOA dues.
Okay. Anything else that they should be building in from if it was a DSCR, PMI, is that rolled into the loan amount?
We don't really see that on the DSCR. Typically, at this point in time in this market, you need at least 20% down. Now, as rates continue to decrease, maybe that'll loosen up.
Okay.
Fingers crossed. But at this point in time,
No PMI. Okay. Talk on, Will, I want you to take this one. Talk on keeping an in-house lender. So somebody that's a portfolio lender that when they give you the financing, they're going to keep it in-house versus someone that's financing and is going to sell it. Should you be looking at a particular loan type, and what is the likelihood that your loan will get sold after you've gotten the loan?
I personally think almost every loan technically has the right to be sold in the secondary market at any point in time. The intention up front is really the key. Like, we are a local lender, so I think working with a local lender has more value than sometimes working with the larger banks, just because there's a lot. If I have any question, like on one of the deal that I worked with Cassidy told me I was wrong about something, and I called my underwriter at 10 o'clock at night and just had asked her, and he was like, and she gave me the answer right then and there.
What was it? I can't remember.
It was
something about the rent.
If you wanted to use the rental income from a departing residence on an FHA, you can't use the departing residence income unless the property is more than 100 miles away.
Got it.
Okay, and I was like,
say that again.
Sorry. So if you live in a property and you're moving out of that property and you want to use the projected rent or a lease that you have and that rental income to offset that mortgage payment on an FHA loan, in order to do that, that property has to be 100 miles away from your next purchase. Okay.
With the current property being an FHA or the one that you're buying?
The one that you're buying as an FHA. So in Cassie's situation, he was going from a single, I think it was a single family or a condo to a multi-unit property. But we were using an FHA loan with a low down payment in that scenario. But that property was about maybe 5 or 10 miles away.
It was in DC.
Yeah.
DC.
So he was like, all right, can we use the rental? I was like, I don't think so. And he was, all right, I forget exactly how it happened. So I called her at 10 o'clock and said, hey, Debbie, I need your help with this. She's like, nope, it has to be 100 miles. And she was so confident, right? So I didn't even question it. And I called him, like, nope, that's wrong. I was like, look, it's 10 o'clock at night. She might just be passed out drunk. I don't know, making it up. Let me just follow up with her in the morning. And then I looked on the FHA guidelines and it was 100 miles away. Yeah. So there are little quirks to that when you're looking at it. But I apologize. What was the question?
Yeah, I don't even know. I was Will save my ass in this particular situation, and I think it's a good segue. So I originally was buying this as a primary. We're not here to talk about primaries, but I knew that I wanted to live there for X amount of time, move out, turn it into a rental property, right? That was my plan. That was the business plan. I originally had another lender that screwed me. I don't even know how you got it done.
Oh, so it was because that one was The other lender was saying that on an FHA guidelines that you can't own more than 7 properties.
Yeah, 7 property, yeah.
But the FHA guideline is actually you can't own more than 7 FHA properties. So if you were purchasing it as an investment property, which is really weird because I don't know how you would utilize an FHA loan on an investment purchase. If you read the guideline, it was something like quirky like that, that if
His
like,
bank could not
and that's where we're going with
couldn't do
this.
the loan.
Yeah. So
They
like
couldn't do it.
dealing with a local lender at times, like my underwriter, she's been with the same company for the last 25 years or plus. And so, and this is the difference is that like, if there's questions or something that comes up, we're able to address those issues right away, regardless if we're planning on selling your loan in the secondary market. Because if somebody is giving you a 3% rate and I'm giving you, let's say 3.25% rate or 3.5% rate, but they can't close the loan in time, then why does it matter? It's the same thing on the DSCR stuff, right? Like having the ability to have the local lenders help you get to the next step, especially when you're dealing with multiple properties, multiple tax returns, self-employment, stuff along those lines. Yep. It starts to help streamline and make sure that you're not just throwing money out the window. Because in that scenario, you would have lost
It was a $50,000. It already gone hard. It was,
and the listing agent, how we met was like, I don't care.
Yeah.
This guy's not giving up the 50K.
The listing agent actually introduced me to Will.
Yeah.
Said if anybody can get it done, Will's going to get it done. So thank you, Will. Good job. Let's give Will.
My time is downstairs. No, that's the.
Yeah, we don't like it. So, but moral of the story with that property, I bought it. I did some rehab. I lived there for I think 18 months. Opened up a home equity line of credit. I now have that property as the bank. I have a $116,000 line of credit on that property that I can use at any time. It's now tenant occupied. It's cash flowing like $150 a month because I bought it with the 3% interest rate. Now the issue now, that property doesn't work in this current market. How do you make properties work in this current market?
That's a great question.
Yeah.
Short-term rental.
Short-term rental.
Yeah.
You bring more cash
Yeah.
or you find another way to make more income off of it.
Right.
Right. So that's one thing I wanted to touch on is that some of the situations that we talk about and that we've experienced that people have done, it's not going to work right now. Right. Rates 6.5, 7.5, right? Dependent, like you have to get creative with the type of financing because financing is what makes the deal. So you have to use individuals that get creative to help you buy it. So now we talked about my situation. We're going to talk about Michael Cook's situation now because he's buying a short-term rental. I want you to kind of, without like exposing everything, how did you get creative with him to buy? Because we had a few late night phone calls.
We did.
Arguing like, this is what you can do. This is what you can't do. And that's another thing too, is like, you gotta be able to have conversations. What did you do to help him get to this property, into this property?
Well, and there were a couple of different moving pieces as far as whether or not a property was going to be sold, right? The multi-unit property.
Has a quadplex, is going to sell it. Do you leverage the equity now, or do you sell it later, 1031?
Mm-hmm.
But this particular opportunity, he had to move on it now,
Right.
Or he loses this short-term loan.
So ultimately, he had a home equity line of credit on his primary residence. That was, when did you originally open that? I mean,
First one?
Yeah, the first one.
7 years ago?
yeah,
Yeah.
7 years ago. And it was a 9.75% interest rate.
9.5.
9.5. So ultimately, we knew the house was worth more because of all the work that he's done on it over the years. And a lot of credit unions out there have great intro rates on their HELOCs. So I reached out to, someone in my network. It's not my deal, right? It's not my loan, but that's okay. And we got him a great intro rate with a credit union and took the equity line from $40,000 to $240,000.
So she leveraged her network on his primary. He already had a line of credit open, 40 grand, but I think he would use like 25, 30 of it to rehab or whatever it is, life. So Lauren had someone that did 99%
Up to 100.
100% LTV on a line of credit, right? A HELOC. So he levered another asset. He would have never known about it if Lauren didn't tell him. Like we were going to use Tower Federal. It was going to be 90 or something.
Tower City, yeah.
Tower City, yeah, something that, but they leverage because this house he couldn't qualify because he had the debt from his primary residence. He had the debt from a quadplex. Interest rates on the quadplex and the line of credit were increased, but he knew that this property works. So Warren put him in contact, got the HELOC. So now you opened up the HELOC. And then what are you doing with the funds after the HELOC?
We are actually using it, we're calling it a second home.
Got
Because he does qualify since we're not selling Richmond. So again, it's pivoting.
Yep.
When things change,
Okay.
how do you work around that and make that work to your benefit?
What is a second home? What are the qualifications for a second home?
So ultimately, we're just not using any potential rental income to offset the mortgage liability.
So they won't let you use any
No.
if it's a secondary.
No.
Everybody hear that? Secondary home, there's a big difference. You have to be able to afford it. You have to have the income based on your DTI to afford the secondary home. Investment product, different, right?
Right. Well, and yes,
They'll use 75% of the loan.
and that's the other thing is that it used to be the second home's rates were pretty much exactly the same as a primary residence, and that changed to now they're equal to investment properties. So if you're buying an investment property or a second home, regardless if you're using that rental income or not, typically you get the same exact interest rate because of the way it's structured now through Fannie Mae. Okay, and because on a second home you can put a minimum of 10% down. Okay, the problem on the second home though is that mortgage insurance companies don't want to lend on a second home, so ideally they really want you to put 20% down. And the second issue is that it just gets really expensive, especially on a Fannie Mae product.
Right.
When you're not a DSCR loan or regular, like it gets super expensive where it doesn't make sense to put 15 or 10% down. Whereas before, back in the day, I would say, I think it happened, 3 years ago?
Right.
Yeah.
It's COVID.
I mean, that
So
was-
they made that change, and which was great if you're buying a second home right at the peak of COVID, because you could get a great rate as a second home. That's a primary, that technically would be this equates to a primary residence. So they made that change, and now it really, unless you need that income, you wouldn't count it as an investment property in that regard.
And that's one thing I want to touch on is during COVID, and I kick myself in the butt all the time because that was one of the best opportunities that I've ever seen to buy secondary homes. They were offering 5% down. Some were 0. Right? You could finance 0 to 5% down for a secondary home. It's a secondary home, but eventually you can turn a secondary home into a short-term rental,
Yes.
depending on the regulations. So the lesson of that everybody should take away, financing is the most important aspect of buying real estate. Individuals that say it's price or the exit or the ARV is wrong. It's how you finance it in order to purchase that property, right? Whether you're buying 150 units or if you're buying one, the financing and the debt on that property is the most important aspect because you can get creative with how you exit it. So let's go back to Michael. So he took out a HELOC. He utilized his primary residence, right? So he's got a line of credit, $200,000, whatever. He's using it to buy the short-term rental. You want to touch on what is the plan after that?
With the short
So you're buying the short-term rental on the 3rd of this month.
third
So like, what's the strategy now you're going to execute? So you've got loan, short-term rental.
Oh yeah.
Okay, what's the strategy?
So there's obviously if you own or if you've looked or stayed at a short-term rental, there's a couple things that a short-term rental has to have. And the first thing is marketability. So how do you stage your property? What are those amenities that you are going to have? And some of those things take sweat equity, like barrel sauna. You want a barrel sauna out on the deck? Well, you might have to put it together. You're going to pay a contractor to do it. Those barrel saunas are about 30 days out from shipment. So planning your hot tub, any reno you're going to do, ordering furniture if you're getting any design work done, coordinating that list, and then also, depending on your market, knowing the date you want to hit to be listed. My scheduled date is about 3.5 weeks out from close, as because James Madison University is having family weekend the next weekend. So I want to have my property available because that is like a secondary holiday for the area. So I want to be able to hit that date.
So you get a ton of money coming in. What's the plan with the cash flow? You obviously
Pay the mortgage.
pay the mortgage, but
First
then
mortgage payment.
Yeah, so mortgage payment and then excess. Hopefully you have excess with the cash flow, right? We're talking about investment products. You should have cash flow. What is the plan with that?
With the cash flow,
The cash flow.
so $25,000 minimum reserve.
Got it.
25,000 in it. That's going to cover. It's going to let me weather the storm in case the market completely crashes and the resort that I'm on shuts down. I can make these payments a handful of times and find an exit strategy, or a different plan for the property. The other factor that is, if the roof, the HVAC, or something goes out, you have that cash available to get it repaired, get it replaced, and not lose rental income. And then if it builds up, if there's a next
line of credit. I was trying to get to, he's going to pay off the line of credit. He's going to use the cash flow to pay off.
I get 25 first.
You got to get 25K.
Yeah.
Right? You're going to be paying interest. I know you negotiated like a lower interest rate on the first 6 months. So the 6 months you're playing with the house's money, right? So you're playing because your rate was cheaper for 6 months. He's able to use that cash flow to invest back into the property in terms of furniture, stuff, whatever it is, saunas, and then reserves. And then it's take all that cash. You don't spend it, right? If you don't have a lot of money, you have to leverage the assets that you have intelligently and safely. But once you get the cash flow, you have to use that cash flow to pay off the debt that you have now incurred from buying those assets, and then you can do it again, right? His plan is he's going to sell his quadplex, pay off the line of credit. Now he has the line of credit free and clear, has some cash, has a short-term rental. It's going to make him $2,000 a month, somewhere around $2,500 a month, and now he can decide what it is. But until you execute the business plan perfectly, leveraging the financing that you used, you need to use the cash flow appropriately, right? So next question. Sorry, we just went out on complete underwriters. All right, so I'm going to talk about underwriters. When someone sends you a loan package, what are they asking for, and what are the most important documents that you need to have prepared for you, whether you're buying it through an LLC or if you're buying it through a primary residence? I'll let you text primary, LLC, or personal name. What docs?
Well, I think 2 years of tax returns, 2 years of W-2s, 1099s, K-1s, whatever you may have, 2 months of bank statements. The more information that I have, the better. So yeah, an entire credit package.
Okay. How important is credit in this sense?
It's pretty important.
Pretty important.
Yeah.
What are our numbers that we need to hit?
At least 700 for sure.
So, and that affects the interest rate?
Oh, absolutely.
Okay. All right. LLC, buying a property through an LLC.
A little bit different.
Take a seat. Bro.
The one program we have, typically the down payment, I think is 20% or 20 or 25% down that they will allow you to do the LLC if you're not doing the DSCR loan. In that regards, the business has to be established in the state in which you are. The LLC needs to be established in the state in which you're purchasing the property. So if you're purchasing in DC, that LLC needs to be established in DC. You need to have that established before you go under contract or before we start the loan, technically. So those are your two biggest items, and then of course your standard qualifications. A lot of people don't really realize this, but if you purchase a property as an LLC, and you're not doing a commercial loan, you're still personally guaranteed on that loan. So you're still documenting tax returns, bank statements, pay stubs, however your income is structured. Obviously, if you're self-employed, the more documentation, the more properties you own, the more documentation. Those are usually the biggest headaches, but Laura and I always try to make sure that we do our due diligence up front. And part of that reason why is because the time that you spend to find a property, to put in an offer, to go through the home inspection, pay for the appraisal, the last thing we want to do is put you in a position saying we can't do it because we didn't do our due diligence up front.
So a lot, in most cases with an investor, if you're an experienced investor, you start buying stuff under LLCs, right? Just because you start an LLC does not mean that you're going to be able to get 100% non-recourse debt, right? They're still going to be looking at you, the individual, going back if it's a long-term rental or if it's short-term rental, DSCR, long-term rental, 75% of the projected income. Correct?
And Michael and I were talking about this earlier. You can, if you purchase a property as an individual and you put it into an LLC, technically the bank has the right to call it due because you changed the name on the title documents.
The due on sale clause.
Correct. The chances of them doing it are very rare, but you have to be prepared for that as well. You can always put it back, but it's just one of those items that you just need to be aware of if you are going to switch it over. It doesn't eliminate a lot of your liability that you would think it would, because you're still responsible for it and still opens you up if somebody gets hurt or something along those lines. But it is something that a lot of people think, oh, I'll just do that as an individual, put it in an LLC afterwards. Usually when you do that, you have the transfer and recordation tax. So depending on where you're purchasing, like in North Carolina, it's $1,000. Here, it's based off your loan amount, I believe, or your appraised value. And then same thing in Maryland. DC there isn't a transfer and recordation tax cost for it, but there's going to be some type of tax for it. So that's something else that you have to be aware of as well.
What if you did like a quick claim deed?
You could, I don't know.
We did that with Fifth Street. So I've done this once. I have experience on this one time. Not Fifth, sorry. This is another one. This is Glen Clark. So I owned a property in, let's just say, Cassidy Burns LLC. I was doing a 1031 exchange. So I sold the property. I had the property ratified to sell, and I knew I was doing a 1031 exchange. I could not find anything, and I was coming up to my dates, right? So who knows who can answer this question? 1031 exchange, what are your timelines? 45 and what? 180. 45 and 180. 45 to identify, 180 to settle, right? 45 days starts on the day that you settle on the property that you're selling. It's good. Write that down if you're taking notes. 45, 180. They will not budge, right? You are messing with the IRS, right? Tax 1031 exchanges are backed by our IRS mandated laws, right? 45, 180. So I was probably at day 35, and two of the properties that I wanted to buy, because I had already filled out my form. You never want to send it to your 1031 intermediary before you have it under contract. This is the whole learning lesson. But you only get to identify 3 on the form, right? 3 that you can submit to your intermediary. They are submitted to the IRS. 2 of them went under contract. They were gone. Oh shit! What do I do? So I did a quick claim deed, transferred it from Cassidy Burns LLC ownership to Cassidy Burns, because then my plan was to buy a secondary home. You can't buy a secondary home with a 1031 exchange. I learned that after I had already switched it, just so you know, right? It has to have an income producing aspect of it. What did Lauren say with secondary homes? They can't count the rental income. Screwed myself. Did the quick claim deed. I was able to switch the deed. This is before settlement. Switch the ownership name from Cassidy Burns LLC to Cassidy Burns. But then I ended up screwing myself. But yes, you can do that before settlement. They did not do a due on sale clause on me. Doesn't mean that they won't. But then I had to buy the 1031 in the person's name who was the owner at settlement, which was Cassidy Burns at that moment. All right.
But your mortgage was still in the name of Cassidy Burns?
Yes. So the quick claim deed triggered and it switched it. I should.
Yeah. So you can do that. Yeah.
Do as I say,
Yeah.
not as I do. Right. Like
Right.
learn from my mistakes. Yes. You can do it though. You can switch and it worked, but I don't know if it will work every time.
Right.
So it's all nothing. Last thing I want to talk about is, sorry, I lost my train of thought. Do we have any questions first? Personal situations?
For the short-term DSCR loans, when you're evaluating the rent to debt service coverage, what are you using as your data to, I guess, effectively estimate what the rental would be for short-term?
That's a really fun question. It depends, right? So ultimately, we will order an appraisal with a rent comp schedule, but it's just a short-term rent comp schedule. So at that point in time, we're married to the appraisers that are willing to complete a short-term rent comp schedule within that area, which is few and far in between, depending on the area. Luckily, Michael and I have kind of rounded up, 4 realtors at this point that will do short-term rent comp schedules in
4 appraisals.
or appraisers, excuse me, that will do the short-term rent comp schedules in the Massanutten and Wintergreen area. So that's been the biggest challenge, right? We can have the data all day long, but if they're not willing to use the data that we have, then, you know, we have to deal with what their appraisers come back with.
And we've had situations too where appraisers will literally not do the rent comp schedule. So if there's like a time crunch and the first appraiser won't do it and they let you know 5 days in, you have to cancel that appraiser and then find another.
Because it's a necessity.
It has to happen.
Yeah.
Because the DSCR, you just can't do it based on value. You have to have that rent comp schedule.
Right, absolutely.
I figured out my talking point, and then we're going to open it up for questions. The last thing I want to talk: who here has a business, runs their income through a business? Right. It's a little bit harder to get a loan. Right. So when someone is a business owner, you can use me as an example. I run all of my income through Cassidy Burns as an S corp, and then through Cassidy. Let's just say Cassidy Burns LLC. Cassidy Burns LLC pays Cassidy Burns S corp. I'm an employee. How are you looking at that income? If I am depreciating everything through real estate, because I own real estate, how much is that hurting me on being able to qualify for my next purchase?
It just depends. So that's like a very loaded question because there's just so many items that go into it, especially being self-employed. For an example, if you are Fannie Mae or Freddie Mac, if you're doing a Fannie Mae Freddie Mac loan, typically if you've been in business for 5 or plus years, there's a very likely chance I only need 1 year of tax returns rather than averaging it over a 2-year period, which is the standard rule. It is case by case, but typically that is the rule.
In business, explain that. LLC has been incorporated for 5 years.
5 years, 5 years, but correct.
Okay.
So because of that, we're looking at the business returns depending on your ownership. You have 25% or more in that ownership in that business. If the answer to that is yes, then you're technically self-employed. If the answer to that is no, then we're only looking at the K1. Okay. As for rental income,